Good day, folks. This morning was quite a bloodbath out there, so much so that I actually went and picked up one stock that I want to discuss in this video. But I mean, there's some real windows of opportunity presenting themselves today, and I want to kind of talk about it firstly with kind of the mega tech companies that have completely traded off now from their incredible record-breaking earnings. We're going to talk about Google, Meta, Amazon, Microsoft. As all this money is kind of rotating into the lower half of the market. The SCHDers of the world very much celebrating the intense rally that has gone on year to date. On the Canadian side of the border, we are still in the midst of kind of an earnings cycle. At the end of the month, we're going to start getting the bank earnings. We're getting kind of the precious metal earnings right now, the utility earnings. We just saw Enbridge today. We'll discuss those stocks actually crushing it right now year to date, or even on the week. Some of the major performers within the market. If we look at the year to date, again, the non-energy minerals, your gold, precious metal companies are the ones that are still really driving a lot of the returns. Regardless, guys, if you looked at the market this morning, there's still quite an intense sell-off, concern, fear that is driving a lot of these wild mood swings. And I'm a guy that loves these kind of mood swings. As mentioned, like, I'm stuck paying some big bills right now, taxes. I pay my auto insurance annually, and I'm kind of like a little bit strained of cash, but still, when things open up like this, I'm like, I'll find a little bit somewhere. And I went ahead this morning and actually purchased another several shares of Take-Two Interactive, which I'll talk about in a moment. Regardless, I really want to dive into these tech stocks, because we've been having real conversations in our chat group, like, are these worth buying today? Are they cheap or significantly cheap? And the only metric as a fundamental guy here, on the back of what were incredible earnings, I want to look a little bit forward, and I want to see the values based today and what's expected in the future, because Amazon, for the first time, I think materially is looking actually cheap. It's trading at a forward PE right now of around 24. And if you just take a look at the historical PE, where we sit today at around 28 is actually the lowest PE virtually in its publicly traded history since it started posting earnings, like actual net EPS for shareholders, right? With the exception of the volatility in 2022, this is actually the cheapest value Amazon's ever traded at. When it comes to a stock like Microsoft here, again, it's crazy to think it's trading at a forward PE of 24. This isn't like major discount territory, but again, this is the lowest multiple on the back of like some of the best earnings Microsoft has ever posted at a 25 PE. The last time it traded at this was the 2022 crash, and you'd have to go back to like 2019 to see numbers that were even familiar to this. So again, guys, these are very rare moments throughout these stocks' history where, again, I think there's only been 3 times in the last several years you've seen valuations this low on a company like Microsoft. So Meta, again, I think one of the gems, if I didn't have so much exposure already to the big tech companies like Meta, like Google, I would be a buyer here. To be fair, if they drop materially from here, I will definitely be a buyer again, just so long as it lowers my overall weighting, because I just can't keep throwing money at Meta when it's already such a large position in my account. Regardless, though, if you look at the valuation right now, I wouldn't say it's like a screaming buy, like screaming cheap, but the forward PE of 22, it's definitely the cheapest S&P top 10 company today. Continues to be. I'd be a buyer here regardless, but it's not at a multiple level, trading at levels. Again, the cheapest multiple was that 2022 crash. Again, that was exceptional, but this is actually a relative normal PE for Meta, and it's still a great value at this level for the growth rate you're getting. It's the fastest growing S&P Mag 7 right outside, with the exception of Nvidia. And, it trades at the cheapest value, right? But Bill Ackman made a $2 million bet on Meta Platforms. And what's crazy is he's probably paying a higher price than I did, because, I don't know what my average Meta buy-in price was in total, but I think even today I'm still up 4% after all the gains have kind of been wiped out. I think I'm in like the low 600 range, whereas today we're trading at about 645. So yeah, it's neat to see some of these big investors, kind of cool, like when Warren Buffett backed Google, kind of as a bit of reassurance that these mega hedge funds are now catching on to what us retail were kind of early into. We should mention Netflix here as well. I'm not a fan of Netflix personally, and never have been, but I can recognize that it is trading down again quite significantly. It is down 42%. Again, these numbers that we're seeing drop off, again, to some degree not as severe as 2022, but we're getting there. It's kind of crazy, really. Netflix trading at a forward PE right now of 24. Again, some of the cheapest values in its history as a publicly traded company. So I'm not a big Netflix fan, but again, people are bringing these up to me, and I'm like, yes, if you have conviction here, Again, I'm not saying we're in deep discount territory, not like when Google was trading at a 17 times multiple. We get to those levels. Like I'm leveraging the farm here, folks. But in this current market environment, I think there's good places to start cost averaging, which is, I was going to hold off on buying Take Two. I literally only bought a little position just to keep my eye on it. I said come spring into summer, I would be getting a bit more aggressive building the position out. But as of right now, I think the discount is here. And, so I picked up, again, another several shares at 190. This is the parent company to Rockstar, the company that will be releasing GTA 6, what I'm suspecting to be the greatest piece of media release in human history that'll generate probably somewhere between $5 and $10 million in $10 billion in revenue on release. That is my speculation. And with the current earnings the company's already producing, I think this could really easily double. I think they could be making currently half their market cap or even higher in revenues in a given year on the release of GTA 6. That could propel the stock up to an $100 billion valuation. That's my bet with this company, and I'm a little bit more reassured seeing the CEO. I know he's came on before and delayed the game, but I don't think we're getting any more delays. Just listen to the first 20 seconds of this, and then we'll talk about some of the Canadian stocks.
I know that you're not going to release something until it's perfect, and I wanted to be sure that this November date is still good.
Right, November 19th.
Now, how do you know? How do you know it's going to be ready that day?
Well, because we actually obviously track the progress daily of everything that we do. And we also announced that we have marketing beats coming this summer, and we don't spend money on marketing until we're pretty close to release.
So again, the reassurance here is that I'm hoping, and again, if everything follows through here, we're going to start seeing the marketing in summer, which is why I kind of want my position built out through spring. Again, it's not going to be like a huge material position because it is really speculative in nature, but I will still make it a materially sizable position just to make sure I can capture some of the impact of hopefully the hype that this game brings. And if I can just say one thing about finding value and making real returns in the market, I keep seeing comments, and I get that if you don't like me, don't like me. It's fine. But people are like, you bought Take Two too high. Or, I was kind of comparing Tesla to BYD, and people are, but Tesla price is up in the last year. And I love that that's their framework for success. Is like a very short window where, like Tesla's an example, fundamentals are flatlining or decreasing at the stock prices going up. That's usually not my favorite metric of investing in the market. Usually what I like to see is stock price going down and fundamentals going up, because the only time I've made a lot of money and found real success is when stock prices crater. The 2020 pandemic was arguably the biggest piece of wealth building for me in my entire life. The money we made coming out of the pandemic was insane. Same with the 2022 crash. The Terra 4 was fabulous, and now we're getting some deals again within the market. But I want to remind you that BYD trades at a 20 times multiple. Their revenue growth is disgusting. It's double digit in the 20 percentile range. They're going to be producing up to like 20,000 humanoid robotics. I think coming to the end of 2026, they've proven that they can take Tesla's business models and absolutely crush them, because China is the behemoth of manufacturing success. And honestly, I think it is a buying opportunity severely over what Tesla's trading at today. And I just think it's funny that, again, fundamentals go up, stock price comes down. That's your window of getting rich. But looking at me and judging me because I have a plan to continue to buy Take Two and some of these stocks when they actually go down in value, I think is just hilarious, because I can't judge where a company's going to be in the next year. And sometimes we get lucky and they do recover quite successfully within a year, but I'm usually looking at these in 3 to 5 year windows. But yeah, I think I can't get over how people think in this market environment. It's why most people are getting wrecked today, because they look at companies like Tesla and they chase the hype. Palantir, like they're buying these stocks at all-time highs. Hood, again, if every one of the grandmothers talking about it, guys, the chances of you getting rich there at this point are incredibly slim, or at least making like severe returns. So I want to talk about companies right now on the Canadian side of the border that have been actually offering some pretty good returns with this rotation out of the tech companies, now moving into some of the energy and dividend-oriented stocks that have been achieving quite a lot of success, which again, I'm not like over the moon about anymore, because as I pointed out in some of my videos with like SCHD, there's a lot of holdings in there like Pepsi, and even on the Canadian side of the border where dividend stocks are becoming quite valued, and that's why we're seeing some of the discounts within the tech companies. But Enbridge here, I don't know if it's crazy expensive here or not. I'm glad that I get the exposure through a VDY, but it is definitely taking a lot off on its recent earnings, doing very, very well. If we scroll down and just take a look, this is, if you're unaware, it is the behemoth. It is the blood of North America, the largest pipeline company in the West here. I mean, going all the way from Alberta all the way down to Texas. It's kind of crazy how insane the pipeline system this company owns is, let alone when you're talking about like the natural gas, they're controlling after the acquisition. I think it was just over a year ago now that they did that acquisition of that major natural gas company. They're building massive amounts of storage when it comes to renewables for the mega tech companies like Meta and Amazon, which is really neat to see. But if we take a look at the earnings themselves, again, Enbridge absolutely crushing it here. Adjusted EBITDA 5.2 billion versus 5.1 on the year to date is 9.9 billion, almost 20 billion versus 18.6 year over year. If you just look at the distributable cash flow, 3.2 versus 3 billion same time last year. So Enbridge on an absolute tear. If you look at something like Cameco here, this one is just, I wanted to bring it up because everyone keeps asking me about it, and it's not a stock that I'm overly familiar with, other than it's the basically largest storage company for uranium, sell, trade uranium. Revenues year over year, now the growth rate wasn't insane. Like, this company trades at a wicked high valuation, and the only reason I can presume that it trades at this really high valuation isn't because of the earnings, right? Because the earnings are okay. I mean, it's reasonable growth, 3.48 billion versus 3.13 billion year over year. Again, reasonable growth rates, like, just high single, sometimes low teens, nothing crazy for a stock that should be trading at 100 times multiple, but it's the value of the uranium that they sit on. I haven't looked too deeply into the recent earnings report, but, based on Gemini, they were holding something like 450 million pounds of proven and probable uranium mineral reserves, which is insane. And obviously, when uranium just spikes up, those reserves become worth an ungodly amount more money. I mean, you can run the math, right? Like, their entire market cap value is basically just sitting in the reserves. So when you look at this, you want to look at that market cap more based on the reserves over the fundamentals of the company itself. But yeah, it's not one that I personally hold, but it has been neat to follow for sure, especially in this uranium cycle. That, again, I think uranium is trading at like decade highs. It's doing exceptionally well. Utilities as well. I mean, again, the broader Canadian markets have just been crushing it as a whole, but utilities have definitely been on a tear as of recently. Again, trading up at higher multiples than they historically usually do. Hydro One posting, again, their reasonable growth rates, net income year over year from 1.1 billion to 1.3. Again, we're talking about companies that do not grow anywhere near to the scale. Again, I'll remind you, like Hydro One, trading at a 26 PE is more expensive, especially in their forward PE, than that of like Meta. That of, again, like, it's kind of crazy when you're looking at stocks like Microsoft, right, trading at a 25 PE. Like, I'm just saying, like, you can understand that I'm a fundamental guy. And again, when fundamentals are going up dramatically and stock prices are coming down as dramatically as they've been coming down, I don't know how you would want to chase the dividend side of things when the, again, opportunity is starting to open up and it presents itself in a very obvious way. And again, this could just be margin unwinding, people, again, last in, first out, getting shaken out by whatever's going on with CapEx. I don't know. It's all kind of fugazi at this point. But like I said, you don't need to be a genius here. It's funny that people think that, like, the market is so efficient that, like, oh, then why wouldn't Wall Street be picking it up? Guys, why wasn't Wall Street and Warren Buffett buying Google at a 17 PE and we were? Like, again, the broader market is a lot stupider than you think in the short term. So just be well aware of it. Again, I'm not a financial advisor. I'm not telling you to just go out and buy Microsoft. Obviously, I'm just showing you how I think and personally what I do within this market. Again, if I wasn't so over leveraged in tech today, again, that's where probably the substantial part of my money would be going if I had the capital to spend right now. But unfortunately, this is a bad time of year to not have capital for me just because of taxes and general expenses. So I'm just sitting here, guys. I'm very happy with my current exposure to the market. Again, the ETFs are kind of removing a lot of the volatility between VDY and VOO, at least bringing in some yield. I'm going to keep buying Take-Two Interactive, again, trying to build it out into probably about a 10, 20K position. And then we'll see as we get closer to GTA 6 in November what that could possibly bring. But again, I can't buy Google or Meta here. My price points are so damn cheap. I don't really care what they do. There is some potential for me to maybe pick up some Amazon or Microsoft down the road, potentially. It just depends on how much capital I'm able to make in the next couple months and if these stocks stay as suppressed as they are today. I'm a guy that always wishes these stocks would stay down for longer. They usually don't, but time will tell. I'd love to know what you're doing, though, in that comment section below.